All right. Hello, everyone, and thanks for joining this week's Real Estate Roundtable. I'm Jayson Bates, the host, and the host of a podcast called Valley of the Sun Real Estate Show. You can check that out by going to my website at www.valleyofthesunrealestateshow.com, and you can connect with me there as well. If you're looking to buy, or I should say, purchase or refinance a home here in the state of Arizona, please give me an opportunity. I'd love to earn your business. And I'm again joined here by my co-host here, Jorge Huervas. How you doing, buddy?
All right, man. How's it going? Happy New Year and Merry Christmas and everything else.
Yeah.
And I'm glad to be here. Glad to get this show started out again for 2016.
Absolutely. Yeah. The first blab of 2016. And if you're not joining us on a blab, please do so. I mean, it's a really cool platform. I think you get a lot of value out of it. It's very interactive. Plus, you'd be able to see my face. Maybe that's a good thing or a bad thing. I don't know. But it's really cool. So for anybody watching this on a replay, check out the blab. Follow either myself or Jorge here, and we'd love to connect with you that way as well.
Absolutely.
All right, cool. So let's get into today's deal. Top real estate or mortgage/real estate newsmakers for December 2015. We do this the first Wednesday of every month at 5 o'clock Arizona time. So depending on where you're at, you can kind of plan accordingly. And there were a lot of newsmakers. Now we do this kind of on a I don't know how you want to, kind of a delayed month because we can't really predict what the news is going to be, right? Right. And we don't want to do it weekly and we don't want to do it daily. So we just kind of combine it all into 1 month and we take some of the top news stories that are in real estate and kind of talk about them. So with that being said, let's one of the top stories that I saw for last month was the HUD Secretary, Castro. He made an announcement that the country as a whole is experiencing an affordable housing crisis.
I heard that.
Right. So, and I'll tell you, here in Arizona, I see it big time. I do see it. Prices have gone up so dramatically in such a short period of time that wages really just haven't been able to keep up.
Right.
Yeah.
And so the problem we have right now is, to me, it's very simple. It's very simple in that how to fix it and what the problem actually is. And it's very simple in terms of what the country needs to do to fix it. But it's definitely much more, this relates to the economy as a whole and where the country is at. So Jayson, you said that housing prices have gone up, and that's pretty much across the board in most of the markets. And what the problem is that we have housing prices are stretching up, but they can't go up any higher in some case, in a lot of areas. And when we start saying that there's the problem is that we call it the housing affordability index. Mm-hmm. And so you have this stretch where there's no inventory. There's a lot of buyers out there. However, they are going to be limited in their purchasing power because of how much the bank's going to allow them to be able to finance, which that's a good thing. That's a safeguard that's supposed to be in there. But the problem is that the economy itself is not producing the type of wage growth and opportunities that regular Americans need to be able to upgrade their houses or be able to pay more for their houses. So we have like this thing where you have buyers that would like to buy but can't afford to buy at certain price points. And at the same time, we have sellers that would like to sell their home, but they can't sell their home because the price of their home what it's valued at today doesn't warrant them to be able to sell it. And I don't think that's homeowners. That's not them trying to be greedy or anything. It just doesn't make sense for a lot of homeowners to be able to sell. So in a normal market where we had a normal economy and things are going the way it's supposed to be going, prices would be pushed up. More homeowners would be saying, you know what, now's a good time to sell. But the price points aren't there for them to make it attractive for them to sell. That's the way I see it.
Well, and wages too. I mean, wages play a big part, right? We have a lot of people that are under
wages.
Yeah. Mm-hmm. And we haven't seen an increase in wages. Now, there's a lot of predictions here for 2016. We're going to see companies as it gets more competitive to hire new talent for whatever it is that they're seeking employment for or employees for. wages will kind of follow. That's yet to be determined, really. Right.
But we haven't seen it. Like, we haven't seen some big surge in the lowering of unemployment. And even though the federal government is, and I'm not trying to be political here or anything like that, but federal government says it keeps going down. However, if you're out there in the working world right now, I don't see that really happening. I see people employed, but I also see a lot of people not employed exactly in the kind of jobs and making the kind of money they want to be making.
Yeah, I can attest to that.
Yeah.
Okay, so now that kind of brings me though to some of this other. Whoa, there went my mic. So that brings me though to a couple other things here, and that is there have been some changes. FHA announced last month the increase of the FHA limits in some counties. I think it was 188 counties to be exact, across the country, which is trying to make it more affordable. Right, because FHA, you need less of a down payment. I did read a report last month also that on conventional loans you can get a 97% loan, meaning that you only have to put 3% down. You don't have to put the 5% down.
Right.
But that only makes up, from the report that I read, about 2% of the market share. So it's very, very small market share of that for low down payment. So a lot of people. Just tells me a lot of people are gravitating toward FHA. Now, we've talked about this in the past where a lot of people are now coming out of that penalty box phase of not having a foreclosure, bankruptcy, short sale in their past, or they're beyond the 7-year time limit for that. So maybe the 3% will become more popular as time goes on, but currently it's not very popular. And so FHA's done some adjusting when it comes to loan limits, and so has Fannie Mae for that matter. Which was really surprising because Phoenix, and I don't know what your FHA loan limit there in Chicago is, but in Phoenix it's $271,050. Mm-hmm. And there was a big article here about that because and I don't know, this was from our local newspaper here. Atlanta, Georgia is kind of a sister city. A lot of people kind of look at the size of Atlanta and kind of compare that to Phoenix. Yeah. Loan limit in Atlanta is $342,700, which is huge.
Yeah.
Where here in their medium sales price of a home, the medium sales price, which is not really the factor that determines FHA loan limits, is only $178,000.
Right. Okay.
So the average sales price in Atlanta is $178,000, where in Phoenix the average sales price is $219,000.
Right, but the loan limits, the increases in the loan limits don't really jive up or match up to what reality is.
Yeah. So now this article here, and it's always been a mystery. Even I'm in the business and it's kind of a mystery, right? We just kind of take it for granted what the loan limits are. Mm-hmm. And for those of you listening, loan limits prohibit you from financing more than the set amount for that particular area in which you're buying.
Right.
Now HUD uses the highest median price of a county within a given core-based statistical area. They call it the CBSA as the basis for the loan limit, not the median price for the entire. So in other words, they take, for Maricopa County, for example, they take a certain neighborhood, if you will, to determine median sales price, not the overall county average. And that's where you have this discrepancy in loan limits, because in FHA or in Maricopa County, the FHA loan limit did not go up. Therefore, it could suppress and make it more expensive by having to put 5% down if you want to go above or purchase a home more than $200,000, which comes into that affordability situation.
Yeah. Well, I mean, there's going to be more pressure on affordability, but I wouldn't want to focus too much on the mortgage aspect of it in terms of like we had the increase in rates recently. Did that happen during the break, or was that before the break?
It did.
And we had the increase in interest rates. We had and like what you're talking about here with the loan limits and stuff. What I think is a much bigger problem is where we're at, what I said earlier about the economy, where job growth and job opportunity is, because if people aren't at their jobs and they're employed and getting raises, getting promotions, or see opportunity in other companies for them to be able to move, transfer, or whatever, that directly relates to our industry. we need people to be out there moving and shaking and doing well in their careers, because that is what gives them the opportunity to be able to buy a home. And it's an opportunity, it's a privilege to be able to buy a home and own it and stuff. And I think that's really where the unfortunate thing is, I don't see anything on the political side on both sides of the aisle. I don't see any one of these yahoos really understanding enough about the fundamentals of the economy to be able to fix it. So I think you're going to see like the FHA stuff, with the loan limits. I think this has been a problem for a while now. I think there are certain areas where they just don't get it right.
Yeah, they don't get it right. I mean, right. Jackson, no offense here to the cities I'm naming here, right? But Jacksonville, Florida, has a higher loan limit than Phoenix, Arizona.
That makes no sense.
It
just doesn't make no sense. I mean, my niece could figure that out. It doesn't make sense.
It is a bit of a mystery how that works. But that's our government, right?
Yeah.
Now, on the flip side, on the conventional side, they've also increased. Now, for the most of the country, it's $417,000 is your conventional loan limit, meaning that you can finance and have your loan securitized or backed by Fannie Mae, Freddie Mac.
Right.
Above that, it's considered jumbo, and the criteria for qualifying for jumbo is much tighter than a conventional loan. So, in California, where demand is very, very high, there are certain places there, counties, that they did increase the loan limit. And even in Nashville, Tennessee, which I thought to be kind of strange. I don't know if that's there.
Nashville's a booming town.
Yeah.
There's a tech industry there now that didn't exist like 6 years ago. It's a pretty incredible place.
Yeah. So, but some of these are pretty high. I mean, they raised them pretty significant here. Sonoma County is up to $528,000. Which I think is around the San Francisco area.
That's up there, yeah.
Yeah.
Some of the prices real estate is up there.
Which and that will lead me into my next little headline here, which we'll kind of talk about. But there are some counties are getting increased, I guess is the bottom line for conventional. Right. Contact your local lender and they can go over that with you. And if you're in Arizona, contact me and I'll be happy to go over that with you. But I want to kind of segue that into this next story here, which I read and I was like, man, oh man, are you kidding me? But they're offering zero down. There now is a loan in the San Francisco area, up to $2 million with no money down.
Wow. In Marin County there or whatever it's called, San Mateo County, or is it just? Well,
it didn't say, it just said the San Francisco area. So,
wow.
I don't know if it's county specific. It sounds like it's a portfolio loan that a lender's specifically, going to keep in house and not have backed. And I think it was Wells Fargo, man. I think,
but it would make sense there just because the economy there is different. The real estate market in San Francisco and Silicon Valley, from San Fran all the way down to Silicon Valley, you've got a very robust, very strong market there because you've got the tech sector there, and that delivers.
But you live and die by that, right? I mean, how many techs went under real quick?
But they all rebounded. I mean, like if we look at even companies like Trulia is part of what came out of the 2001, 2002 crash, and it's rebounded, and that's why you have prices have gone up so high. It actually has, for as crazy as that sounds, 0% down for a $2 million loan. That actually, it makes sense to me because of the dynamics that are going on there in that marketplace. So that's a place where housing prices have been able to go up and people have, to a certain extent, be able to afford those housing prices. So now you've got, and it makes sense that's a private, some kind of private equity firm or a private bank doing that because.
Yeah, let me see with that because it's a credit union actually.
Okay, that makes total sense.
San Francisco Federal Credit Union is offering it. Here's the outline of how you qualify for this loan.
Yeah,
right. So check this out. Borrowers must be employed in the San Francisco or nearby, and you nailed it right there, San Mateo County.
Yeah.
Loan must be used for the purchase of a primary residency and cannot be used in a refinance.
Okay.
Private mortgage insurance is not required. Because no mortgage insurance company is going to insure that. The loan is a is a 5.5 arm. It's not just a 5.1, but a 5.5 arm. It can adjust in 5-year intervals. I know somebody was trying to come in the room there, but I don't know what they were doing. Hey, put in the chat if you want to come in the room. If you got something to add, you certainly can join the conversation. Just put in the chat what you have to add there, and we'll let you in. And the loan can only increase by 2 percentage points each time it adjusts. Yeah. So it is an arm, but
for a credit union, that's a safe bet. That's a very safe bet in that part of the country. I think you got price appreciation there. You have a lot of capable, willing borrowers there, and and what I'm guessing is that they're probably trying to target individuals that maybe have not as much cash on hand, but they have assets. Whether it's in stock price or whatever, or they have to stay somewhat liquid, and they need like that type of financing product. That makes it in that area that makes sense, for as crazy as it sounds.
Let me ask you, because we've had conversations before, and Max is in the room here, and I've had conversations with him. Are we beginning to get back to where we were pre-recession by offering these kind of crazy programs, right? We want it to loosen up, and the government has said, hey, we want lenders to loosen up some of the guidelines. Lenders have fought back and say, okay, we'll loosen them up as long as you don't fine us, and we'll get into some of the fines that happened last month for some lenders. So there is kind of a tossing back and forth of who's right, who's wrong, which is the right direction, how loosey-goosey do we get with mortgage lending, and are we getting ourselves back into trouble again?
Right. Well,
so that's why I thought it was kind of, even at the $2 million range, which you're right. I mean, that is the kind of maybe a starter home. I don't want to say starter home, but it's all relative, right?
Yeah, it's relative to that. Yeah. Like for me and you in the markets that we're in, that would just sound crazy, but in a market like that, it's a little bit different. It's much different in terms of pricing.
Right.
Yeah.
That's just a snapshot of the qualification. I'm sure there has to be other things, but saving 20% down on a jumbo that you have to pretty much do now on $2 million, that's a lot of money.
But for the credit union, it's a safe bet. I'm sure, like you just said, they've got some other stipulations. They want that individual borrower to have some assets, and it's just that they don't have the cash to be able to burn on that. So I think in that part of the country, it makes total sense. And the asset, that means that they're willing to make a bet, because they know that if it does have to go into foreclosure or that kind of scenario has to play out, they're going to get their money back. They wouldn't be essentially making that bet or hedging that kind of bet, which is what it is when you start getting to the business of lending money for homes, right?
Right.
Right. Especially for a credit union.
Yeah, no. There may be stipulations where you have to be a member for so many years and things like that. Yeah. Because credit unions, you have to be a member. So it didn't really go into that as far as the article goes. I just thought it was kind of crazy at $2 million. Yeah. So now, with that being said, rent is also expensive, right? So it's not just the poor who can't make the rent payments anymore. So we're starting to see some additional defaults, although mortgage defaults have come down and held steady in December. Rent defaults actually are becoming higher. And in places like California, where demand is so high, rents are going through the roof. And it is getting to a point where, why rent when you can buy? That was a big sales motto for a lot of realtors and a lot of mortgage lenders back in the day. And it's coming back to that for sure. I know it's happening here in Arizona. But the problem is there's not much affordable housing like we talked about at the beginning here. So you want to buy a house, but the house you need is, $2 million. So you're kind of forced to rent because you can't, you're barely making ends meet because you're underemployed. You don't have the ability to save for the down payment. And you don't have the resources for gift money and some other avenues. Yeah. So we're starting to see some defaults in rent because as your lease becomes due or expires, then there may be a clause in there where your rent increases or I have a client right now who is renting, but the landlord says, hey, your lease is up. I'm selling the house. Find another place to live. And so then they're forced to go into another rental, right. Which is at current market value, not 3 years ago market value, and the rent is higher. So we're we're starting to see an uptick in delinquencies in rent, which is not good.
I think that's just a natural occurrence. You're going to have, there's more renters now than we had 2 years ago and 3 years ago. And the fact that you've got more of them going to default, it makes sense. Rents are going higher. More people are going into them. You're going to see some trends like that. But I wouldn't be too, like, for me, I wouldn't be too, if I was in that business of renting out homes and stuff, I think all you're going to see is them be a little bit more cautious on their credit apps, do a little bit more due diligence and stuff. And I think that's just a natural occurrence of what happens when this scenario we're all living in happens.
Yeah. And Max mentioned there in the chat there, shadow inventory. I can only speak for Phoenix, Arizona. There's not much. I mean, I hear a lot from realtors. Hey, there's a bunch of shadow. And then you talk to the guys and gals who represent a lot of the REOs here in Phoenix. And they're like, it's not there.
The whole thing about shadow inventory, and that term was, I don't know if that was created by, what was the name of that? What the website will come to me in a second. Like Max, when my deal with shadow inventory is that I don't think that it ever existed to the point that we all thought it did. There was times during the foreclosure crisis, when we thought that there was some like million homes out there in this like shadow inventory that the banks were holding back from going on the market. That there was some part, like almost like a somewhat of a minor conspiracy that they were going to hold these homes back and wait until prices went up so that they can put them on the market. I think what we really saw happen was that in California, where a bulk of the shadow inventory was supposed to exist, we never saw that shadow materialize when the market did turn around in California, and the market did turn around in California. So, and with the delinquent and late, the people that live in their houses for 4 or 5 years, there's two reasons why that happens. One, the bank who is the servicer on that note, most of those banks a lot of the banks don't own these notes. They're just servicing it. That's how they make their money. When they're servicing those notes and they're not really pursuing the full foreclosure, many times it's because they don't know who the fuck the owner is. They don't know who actually owns that paper. Some of these deals, especially like the stuff that came over from Bank of America and Countrywide, those loans were so messed up that you didn't know who the owners exactly were. So for the banks, in a lot of cases, it makes sense for them to just continue servicing the loan. And then, like, I don't know what happens on their end to decide how long they service it and who exactly they're charging. But in many cases, no one knows who those loans belong to. And on the other side of it, it's just people that are just, you can lawyer up and you can try to fight that foreclosure and stay in that home for a long period of time. I know you probably know, Jason, and most realtors know. And when I was still practicing real estate, I had clients like this too, who found the right lawyers that could keep them in the house for an extra 2, 3, 4 years. And I think that's, you can do it. You can do it, especially in a state like New Jersey or a state like Illinois, something like New York, where we're judicial states. It can be done.
Well, and I'll tell you too, there is another term out there, zombie foreclosures. There are a few of those out there. I don't know the numbers on them, but zombie foreclosures are foreclosures that the bank started but never finished. Yeah. People moved out, and it just kind of stopped. And so It's just out there in dead world, therefore, zombie. And a lot of people actually then go back. But now the problem is that people are held hostage because they can't purchase another house because it shows on their credit report. Yeah. And so they have to go back to the bank and renegotiate a short sale or, start the foreclosure proceedings over again. And the waiting period for which they thought they were already into starts over, because it didn't ever come out of their name completely. Right. So that, for those people that have this 4 or 5 years living in the house rent free, well, personal little story. I've had some family members who lived in their homes for quite some time. They got used to that budget of not having a mortgage payment. Wow. And when the banks finally did come to their senses and get the ball rolling, they now had to rebudget themselves for rent, and that was quite a shocker for them. Yeah. So, if the people living rent, it's kind of cool that you're living rent free, but I suggest, hey, get out of that thing as soon as you can. Get that time frame started so you can get that behind you as quickly as possible.
Yeah.
That's a piece of advice on that.
No, I totally agree with that. And then like the last thing on the shadow inventory, California again was supposed to have most of it, and we didn't see it when the market turned around and we started seeing a decrease in foreclosures. We haven't seen it, and anyone that I know that's practicing in real estate right now in California, they don't see it either. And we thought we had a inventory here too of shadow inventory in Illinois, especially up here in Chicago. And when things started turning around, we did not see that materialize. And we don't see a lot of homes that are just sitting there vacant. The ones that are sitting vacant tend to be in the areas like the south side, north side, or west side of Chicago areas. If you go to Detroit and you see like, complete blocks that there's no one living in those abandoned houses and stuff. I think there's certain areas like that, but those are just decrepit areas where the asset is, worth less than $20,000 or $10,000, and the bank, the bank just, it doesn't make sense for no one, either that no one's willing to take it and the bank's not willing to let it go at that time. But those are the only areas where I know that banks could possibly be purposely hanging on to it. Now, I'm no defender of the banks.
Yeah,
I don't give a fuck about them.
Yeah. No, I don't know that there's any public record. Max was also asking about public records.
Yeah.
For shadow inventory, I'm not aware of that. I suppose you probably could do a search and see who the owner of the property is. But a lot of times I see here in Phoenix anyway, they have banks. The banks have attorneys that represent them. And so it's a little, I guess, I don't want to say gray area, but it's a little hard to decipher who actually owns the property.
Yeah.
Some of them I think are pretty cut and, clear cut. But some of them aren't. And so, I guess you'd have to know what you're actually looking for and who's vested or who's entitled to the property to know if the bank is actually entitled to the property and owns it.
Yeah.
Hey, I want to move on though from this. Because we got some other things I want to cover, and we're about halfway through this, and we can always come back.
A lot more news that came out.
Yeah, we can come back to it, of course. But we were talking about fines. Fines that some mortgage companies. I mean, this is the year, 2015, and in 2016, for that matter, that the CFPB this is the year of enforcement, right?
Yeah.
So. The 2014 was kind of the shot over the bow for lenders. Hey, here's your warning shot. 2015 has been lowering of the hammer on some of these lenders. And so in December 2015, just a month ago, Franklin American Mortgage in Franklin, Tennessee, of all places, agreed to pay $70 million for knowingly originating home loans that did not meet the guidelines for the Department of Housing and Urban Development, HUD, which is FHA loans. Now, it may not sound like a lot, $70 million on Franklin American, I think is number 4 originator in the country or something like that. They're pretty high up there as far as the number of loans that they originate. But it's still a fine. And these sort of things are going to continue to happen because not only did they get fined, but a small company called Rand Life also got fined, and they only got fined $1 million. Now, it's all relative to the amount of volume that they do. But I thought what's most important about this story is that in 2012, the number of non-depository banks that originated loans was 26%, where now it's more than 60%. So that means the market share of loans originated by non-depository banks, mortgage bankers, if you will. And the big banks have gotten a smaller share. And that's just 3 years.
Well, so we kept hearing a lot of them just not wanting to, they didn't stop, but a lot of them threatened to just stop doing FHA loans over the years. Who was the last bank that did that? Is that Wells or?
Well, Wells just raised their credit score requirement on FHAs to 640.
Right.
But Bank of America stopped doing correspondent loans and stuff like that. But that was years ago. That wasn't recently.
I think there's a lot of risk out there, and it would make total sense that they're risk adverse. in terms of wanting to like dive deeper into getting into the mortgage business. They all just got their asses kicked, like they can make money a lot of other different ways, and lending money for homes isn't the only way they make money. That to me, again, that makes total sense.
Here's why I think this is something that is going to be maybe bigger, could lead to bigger things.
Okay.
Because $1 million it's like a small business owner, right? $1 million to them could put them under real quick. Most of these mortgage bankers operate on very, very low capitalization anyway. They meet the minimum requirements for HUD for capitalization, and that's it. And maybe they have a rainy day fund or something like that. But a couple buybacks or a couple fines like this can really sink a company very, very quickly. And if they're doing the majority of the market share for originating, then what's that going to do for pricing, for the cost of a mortgage? If you got fewer players in the market,
it's not good for the consumer.
It's not, and I'm not saying that they shouldn't be fined, right? I don't want that message to be put out there. But
those
fines are determined either. I mean, is $1 million should have been 500,000? Should have been 2 million? I don't know.
You can find the companies, and they should be fined if they're doing something wrong. Okay, but I think for most of the stuff that I read and what I hear, and especially with the new rules set or what the CFPB whatever is trying to do. There's some ambiguity in terms of on a lot of these laws that are out there and what they can and cannot be doing. Some things that it is cut and clear. I think that the fact that it's not 100% clear for all lenders what they can and cannot do. I think that when you have that type of a system, you're just opening it up for. It looks like the CFPB just wants to continue fining mortgage brokers and banks, and they almost have like an adversarial relationship that they just think that all banks are bad and all the people that work at the banks are bad. And again, I don't care about the banks. I'm not a mortgage broker. I don't give a damn about them, But you need to have somebody to lend money to people that want to buy houses. That has happened one way or the other. And I don't know if this is ultimately the end goal of the government. To me, is that they want everything to be basically just turn FHA. That one day we'll get to a place where everything.
I don't think so. I don't think that.
What is the end? Then with the CFPB, with everything they've come out and said, what is the end goal here?
Just like any there is they do have to justify their position, right? Or they're not going to get funding and they get shut down. I mean, the CFPB was only originated because of what were perceived to be shady kind of lending practices, which I'm not disagreeing with with creating a police, if you will, for mortgage lending and finance in general, not just mortgage lending. Mortgage lending has kind of been at the epicenter, but these sort of things happen even in the car industry, the finance industry. And you don't hear about these kind of fines. So we got a target on our back because this industry was kind of the focal point of the debacle that we had in 2008. But I don't believe that FHA wants to finance America. I don't think that HUD wants to insure, because remember, it's an insured loan. And so these things do default, they got to pay it back. Where privately held companies on the conventional,
they don't care. They're printing money out of thin air. I don't think they really. I honestly don't think they care. They're already just kind of doing that as it is, kind of like de facto. So I don't think they're worried about making money. When they make money, when FHA makes money, when Fannie and Freddie are making money, they like to tout that in the news, and so that the politicians and the heads at Fannie and Freddie can say, look at what a good job we're doing. We're making all this money. But it's just, I don't know. It's a crazy situation. But Mike just made that comment on The Big Short, and I definitely want to see that movie. I know a little bit about what the movie is supposed to be about, but I love the whole topic.
Yeah, I haven't seen it. I haven't seen that movie. I've been told from some of my compadres to see it, but yeah, Max was telling me about it, the book, yesterday, as a matter of fact. So
yeah, that looks good. But yeah, like I said, I think this is for 2016. Like everything you brought up, actually, I think to me, there's some crazy stuff going on out there when it comes to mortgage lending. And
Well,
I think we're just going to continue to see a lot of crazy stuff that almost seems like bizarre world sometimes.
yeah, which brings us to the next topic, right? We're kind of rolling here a little bit because CFPB is, and they've already made it kind of clear here in December from some of their news announcements and stuff. They're really going to start looking at mortgage companies and how they compensate their loan officers.
Right,
Now,
right.
this is a big deal. This is something that, in an effort to attract talent, companies will make these elaborate kind of compensation plans for loan officers. Everybody looking for the golden bucket, if you will.
Right.
And CFPB is saying, "Hey, look, there's some shady stuff going on here," and rightfully so. I've been singing this song for about 5 years now, and I'll give you an example here. When you lock an interest rate in with a lender, there's generally a lot of times there's overage baked in within that interest rate. Rarely do you have just the par interest rate. So it either costs money, which is a buy down, reflected in discount points, or there is a credit, a lender credit. A lot of times, and loan officers will use that lender credit as a selling tool to say, "Hey, look, my loan is really good. I'm paying part of your closing costs," and rightfully so. But not all lenders give back the entire amount of that lender credit. So, for example, if you're getting 0.5% back, or the rate sheet for the loan officer shows 0.5% in rebate, that loan officer may only give you 0.25% of that 0.5% in a lender credit. And you as a consumer aren't the wiser about the other 0.25% because the loan officer didn't tell you. So I actually did a podcast on this. And I think this is going to start shaking it up because the CFPB has made a ruling saying, "Hey, look, when you lock in that interest rate, all that money is the consumer's money. None of that is the company's money. That's part of the negotiation when they locked in the interest rate." Now, why do companies use that extra 0.25%? Well, they use that for profitability. It goes straight to the bottom line and hits their P&L. Now, some companies take it a step further and they'll use it as a point bank system where that 0.25% will go into that loan officer's piggy bank, if you will. And that loan officer then can draw upon that 0.25% either in a bonus quarterly or use that money as a buy down on future loans if they're not competitive on a particular loan. And that's simply wrong. So in other words, somebody who negotiated the rate, locked in the rate, doesn't get the full credit for the lender credit, and then somebody else who had nothing to do with that transaction gets the benefit of that money to be used to buy down their interest rate. And CFPB is like, that doesn't work. Now, with companies that do it right, and I will say that my company does, and I'm not going to name names, but my company, we give the whole credit, and I have no qualms in showing my consumers or my customers, clients, the actual rate sheet. And I show it to them. And I've even done principal reductions if there's excess, which is exactly how the CFPB wants it done. And there aren't too many lenders out there that I'm aware of that actually do a principal reduction based on a lender credit. They say if you don't use it, you lose it. Well, CFPB says, no, you don't lose it. You need to figure out another way to apply it. So this loan officer compensation is going to be a big deal. And we're going to see some loan officer migration throughout our industry because of that. And we may see, because of the loan officer migration, we may see some consolidation with companies, and maybe even some companies, getting out of the business completely.
Yeah.
So, that's going to be their focal point, and I think it's a good focal point because it is what it was intended for, which is looking out for the consumer. As I said, when you're a consumer, and I'll make this last point, and you can say whatever you want, but when you're a consumer, once you lock in your interest rate, please ask your loan officer to send you the lock confirmation of the rate of the lock so you can see how much lender credit or what the actual cost of that loan truly is, and then compare that against your closing disclosure.
I think the bottom line is that we're going to continue to see the whole landscape of mortgage lending, the brokers, the banks, and how they get paid, how they charge, how they don't charge, everything about how they operate. I think that's a landscape that's continuing to evolve, and it's going to continue to change. for the rest of this year, and right now to infinity, until the CFPB or the government or whatever decides they don't want to pick on you guys anymore and focus their attention on the realtors or something like that. But for right now, I think stuff like this is it's fascinating, and this is what I think we can expect to see more of.
Yeah, and Max is asking about flat compensation and stuff like that. I do. Here's another thing too that happens with some mortgage companies that the CFPB is ruling on as well, is that if let's say you're on the west side of Chicago, you go to ABC Mortgage Company, and then you get on the internet and you contact the same company, but you get a different loan officer in the north side of Chicago. Well, if that loan officer's compensation is different in the north side versus the west side, then you're going to get different pricing, even though it's the same company. Yeah. So you have companies competing within the same marketplace amongst one another, and that's because of P&Ls and each branch being independently kind of run for a profit center, rather than just having it, universal across the board. Now, from a loan officer's perspective or a branch manager's perspective, P&Ls are great because you can manage your profit that way, and you're not absorbing some of the costs from some of your constituents within your marketplace. So a lot of loan officers, a lot of branch managers go to that P&L model because of that. But for the consumer, that creates a little bit. Now, most consumers don't know that because they go to one loan officer, they get the rate, and they think that's it. They don't bother shopping the same company in the same marketplace. Now, different regions can have different rate sheets because the cost of living and cost of operating a business in California is much different than what it is in Chicago or Arizona, for that matter. So different regions can have different rate sheets, but not the same marketplace. Should not have different compensation. Now, with that being said, and some people would kind of argue with this, but each branch loan officer compensation needs to be universal within that branch. CFPB is kind of, from what I'm understanding, taking it a step further, saying, I don't care about the branch, I care about the marketplace. Yeah. So loan officers and then the mortgage world says, hey, well, my branch is compliant because all my loan officers are on the same compensation within my branch. And that's not in the spirit of the Financial Reform Act, where it should be the marketplace, not just the branch. Yeah. So we'll see what happens. I don't know if it'll go ever to a flat deal, because generally when that happens, it's not in the favor of the loan officer. And I've always said for a long, long time, and Jay can probably attest to this, we don't have a lot of people coming in to replace some of the talented people that we have in our industry right now. Who wants to come in to an industry that your pay's cut, you have to pay all this money to even stay licensed, and you're being told, how much money you can make. Let the market kind of dictate how much money you can make. Right. And so it'll be interesting to see if you go to a flat deal. And here's the other thing too, that I'll say, if I worked at Bank of America or Wells Fargo or some of the big banks where they provide leads and they provide all the marketing and they do everything, that all I got to do is answer the phone. Well, I get paid accordingly, just to answer the phone, right? Not paid necessarily for my expertise. However, the benefits are a lot better, where are, paid vacations, that sort of thing, clock in and out. Where on the mortgage banking side, the non-depository banks, it's really a 7-day-a-week kind of job, and it's 100% commission. You got to pay for your own marketing in most cases, and so there's some risk with my NMLS that if I do a bad loan, I could be fined personally or have something attached to my license. So with that risk, there should be some reward. So a flat deal, I don't know if that will ever happen unless it's a favorable flat deal. And at the same time, keeping a flat compensation for loan officers, that can directly affect the interest rate offered by that loan officer in their branch. And so it's going to have to be competitive with the marketplace, and we'd have to have everybody go to a flat. So I don't know that it'll happen. I don't think that it will.
Yeah, but it's a good question. Can you hear me okay?
Yeah, I got you loud and clear.
Oh, good. It's a good question, though, because I think that's what they're interested in. They're interested in LO compensation, and they're interested in how fees are being charged.
Yeah,
and those seem to be the prime areas that they're really the ones that the CFPB is talking about, and publicly it's in fees and compensation.
Yep, absolutely. Okay, so let's kind of get off that soapbox, right? I kind of my blood pressure's up now. I'm gonna have to get a second job here. Hey, does Blab pay here? Am I getting paid for this? Okay, so PMI companies, private mortgage insurance companies, are going to start going to risk-based pricing. Currently, right now, they're not. PMI is private mortgage insurance. This is the mortgage insurance that you get when you finance more than 80% on a conventional purchase, Fannie Mae, Freddie Mac deal. We're starting to see PMI companies starting to go toward risk-based pricing. Currently, they are just going on loan to value and credit score. That's pretty much it. But we're going to start seeing them go into, and they've already made that announcement that they're going to start doing risk-based pricing. I think UGIC is one of the companies that's actively going after that pricing model. So we may see better private mortgage insurance. We may see not so favorable private mortgage insurance. So be on the lookout for that. So with that, the next thing here, next order of business here, we're talking about fines in mortgage companies. It's not just mortgage companies. It's also CEOs of mortgage companies. Right. There was a CEO here who was sent to prison for a mortgage scheme. And I saw an NFL player too. I don't know, an NFL player's mother. Did you see that? Yeah, there's an NFL player's mother, and I think she was out of, and I'll get the article here, but I think she's out of Tennessee or something like that.
Okay.
My internet's a little bit slow here, but I'll pull that up and talk about that. So it's not just the companies that are getting fined; it's also the CEOs who are actually serving prison time. So the hammer's coming down pretty hard.
Yeah. I don't know why there's still people that even mess with that stuff anymore, but there are. It happens every day. There is mortgage fraud that takes place, and I don't know why people think they are going to be able to get away with it, because they're going to get caught. The government's been hot and heavy on mortgage fraud since the crash.
Yeah, and Mike came to the website here and they took it down. So,
okay,
but it was Western Massachusetts News. It was on their website. So I think it's pretty legit. I don't know, maybe not. But it was on their website. So for that NFL mom getting put to jail. Now, another thing too here, we were talking about San Francisco. Zillow has made a prediction that San Francisco, Los Angeles, Boston may become bubble markets.
Yeah.
Now, I've heard quite a few people say, hey, we're going to have another correction here. We were just talking about a $2 million, no down payment deal. I mean, if that isn't a bubble, right? If San Francisco truly isn't a bubble and it corrects itself, that credit union could be in deep trouble.
Mm-hmm. Absolutely.
Right?
They're based. I mean, did you read the whole? I don't know if you read the article where they kind of explain what they're thinking is going to happen.
No, I just kind of glanced over it or whatever, but they just mentioned those three markets too. They didn't mention any other markets. I don't know about Hawaii or some of the other high cost areas, but
there's no doubt that those markets are overheated. But right now, they're. Oh, hang on. It says that my sound's off.
You're good, man. I hear you loud and clear. Yeah.
Okay. All right, Mike. All right. So I think that when it comes to those areas, there's no doubt that price appreciation is higher in those markets than in any of the other markets, and there is a tension there where buyer home affordability and how much people can borrow, and then what happens is that we don't have enough houses coming on the market for those buyers. So what happens? Something has to break right there. Is do home prices go up, or do more inventory stock comes on the market? But I think they're heavily predicting something like that just because of these low inventory rates. And I think that the low inventory rates aren't the cause necessarily the cause of the problem right here. I think the cause of the problem is that you don't have housing prices going up high enough so that you can have the natural flow of homeowners that want to put their homes back into the marketplace to sell, so that they can move on and go on to another house. So, like right. You said earlier, Jayson, you had a comment earlier about housing prices, and like, did they or the market, like if it came back or not yet. And right now we're only back to like the 2003 level.
Right.
We haven't, there's still, even though we've gone through a lot of foreclosures and short sales, there's not a lot of borrowers out there. Not all the borrowers out there were completely wiped out. You have a lot of borrowers out there that bought at those high prices or refied, and they still own their home. They didn't go to foreclosure or short sale, but they still can't sell. They're stuck in their homes essentially.
Right.
And we still have a lot of those borrowers out there who, in a normal landscape, they'd be putting their house on the market now.
Right.
And
right.
that's how we take care of the inventory problem.
Yeah, well, we're not seeing, at least here in Phoenix, I'm not seeing a lot of eagerness from the builders to go out there and buy a bunch of land and put a bunch of homes up either.
Right.
So that doesn't help inventory. We're in this little bubble right now, if you will, for gas prices. Gas prices are really low. I see here in Phoenix is a spread out area, and people will buy in the outskirts of Phoenix because it's cheaper to buy there. But when gas prices go up, you see all those homes go up for sale because they don't want to deal with the commute and they don't want to deal with the traffic. And I'm sure that's, pretty similar in a lot of metropolitan areas. So it's going to be interesting to see what happens. I don't know. Are we in a correction right now? I mean, when we were at double digit improvement on prices and now we're at single digit, I think the national average was 5% last year.
Yeah,
that's kind of a normal market, right? But if healthcare's keeps going up, if just the cost of living keeps going up, everything else gets expensive. Well, at some point, even that 5% is too much, right? So,
and then the other problem, which we both didn't bring this up, which I think it's a problem. I don't know how you feel about it, is that we have a lot of people that have taken out FHA loans. And there are a lot of programs out there where you only need 3.5%, and in some cases even 1 or 2%. And that's it to buy a house. So you have a lot of homes out there, a lot of homeowners who don't have any equity essentially in their homes. So if there is some type of economic collapse, any type of a stock market crash, a terrorist attack, or something like that, that brings the economy down, and home prices go down 1%, 2%, 3%, we have homeowners now that will be in trouble or be essentially underwater really quickly because of that equity problem.
Yeah, and that was one of the headlines too that I wrote down. Mortgage balances surge, fueling rise in household debt. So it just goes.
I'd be more afraid of that people don't have any equity in their homes than
right.
And if anything, like when a bubble can be caused by lots of different things. To me, the bubble would be if we do come across something like that again, it's going to be exactly because people don't have equities in their home. They have to sell and they can't afford to sell.
I will tell you this though: if I win the lottery tonight, man, $450 billion or whatever it is, I'll be paying off my mortgage. So. All right, so let's. I think I pretty much covered just about everything here. I know there's some other headlines here. We're running.
Yeah,
we're about.
There was one real quick one that I had that I think is really incredible. It's something I want to keep my eye on over the next 2 months, and that's Redfin. Redfin announced last week, or it was right before the holiday. They said that they are going to start going or focusing more of their business on working with homeowners, as opposed to with or home buying selling agents instead of buying agents. So they're going to focus on the homeowners more. And what they're looking at doing is reducing the amount of commissions that they're giving back. That basically what they do is there's a rebate, and they give part of your commission as a real estate agent. They take their chunk and then they give a part back to the buyer. They made an announcement to kind of push more heavily towards sellers. And now the numbers didn't make sense to me. I'm still kind of looking into what they're doing, and they haven't made it a company-wide thing yet. But what they're talking about is somewhere like about 1.5% that they will be giving back to the homeowner is what they're stating right now. So I'm interested to see how that kind of plays out and how what their next steps are going to be and implementation of this.
Well, and we talked about that too before on previous real estate roundtables about building a better mousetrap, right? So there's some of that exploratory, uncharted territory that companies are starting to go down. And I'll tell you too, you don't have this in Chicago. It's only in Phoenix right now. Although I think it's going over to, oh, I lost you there, Jorge. But it's going over to Dallas, Texas as well. And that's called a company called Open Door. And they're kind of redefining the sale of a home and how it looks.
Hello, Jason?
You can check them out. Yeah, you there? Can you hear me?
Lost Jason, or if I lost him, or if you lost me.
I'm good, man. I see you loud and clear. But to finish my thought there, Max, yeah. You what do you have, man? Do you have an Apple computer or something, buddy? But to finish my thought there, opendoor.com, you can check them out. And that's a new and up and coming tech company in the real estate market. So, Jorge, man, I saw you loud and clear. So did Max. I think everybody else in the room saw you loud and clear. So hopefully you are good. Are you good? You back with us there, buddy? No dice. I see you, man. I'm going to put it on here. I see you. I'm not yelling at you, by the way. My fat fingers got in the way. Can you hear me? I guess he can hear me, but he can see me, but can't hear me. Anyway, that's pretty much it. If anybody else wants to jump in the seat here and has anything to add, be my guest. You're more than welcome to jump in. Jay, if you'd like to jump in, Max, whatever, both of you, that's cool. We only got we're going to try to keep it to an hour, but we'll go off the record here in just a few minutes. Oh, you there, Max?
I'm here.
Yeah. I don't know. It must be him, right?
It is him. Hey,
Yeah.
so I just had a quick question for you. So thanks again for joining my blab yesterday about the predictions of the 12 predictions for 2016. And one of them was about treasury bonds. And I fully expect long-term rates to start coming down.
Right.
And we've seen it actually happen over the last couple of weeks, particularly as the market has been melting down. Short-term rates up to about 2 years have been coming up a little bit. 10-year, 30-year bonds have been coming down in rates. How quickly do you think we're going to start seeing that translate into mortgage rates? And basically, I mean, if let's say, for example, a 5-year ARM starts looking almost similar rates to a 15-year fixed or a 30-year fixed, I mean, where do you guys usually see the transition point to start basically, hey, you know what, it might make sense to pay a little bit more, but to have a 30-year payment that you can prepay earlier if you want to?
Well, I'll tell you, I've already seen it here at my company. Okay. I don't know the pricing for other companies, but I've seen it on my end. We just had a midday price improvement today. Now, they make the argument about China and their GPA or GDP or whatever, being at double digits back in 2000.
Back in here. Did we lose Jason, or is Jason talking?
No, Jason's here, George.
Okay, sorry about that, Jason. I must be a connection problem on my end, real quick. So let me cut out. I'll stay here in the chat room here, but I must have a problem with my connection or something like that.
All right, cool, man. So yeah, we've already seen some rate improvements here, at least where I'm at, over the last couple of days. Now, whether that's attributed to China, or what, that's kind of the news that I'm getting. It's attributed to China, but I don't know if that will continue. I know one of my headlines for month of December was Freddie Mac looking at the interest rates. A lot of people were predicting that they would go up to 5% by year's end in 2016. Freddie Mac actually made the prediction that they would go up to like 4.4%. Yeah. And I think just last week, the 30-year fixed average nationally, I think just eclipsed 4% last week. And I suspect this week it'll probably go back just below 4%, given what we've had happen this week. So, and here's the other thing. When you're asking about ARMs right now, aren't really favorable in the secondary market because of the riskiness in what the market. So now they're priced very, very well in the jumbo market. In the jumbo market, a lot of people go for the ARM adjustable rate mortgages, but there's not a significant enough spread between an adjustable rate mortgage for the average consumer and a 30-year fixed to justify the risk of the ARM.
But I mean, for instance, what's the 5-year ARM? What's the 5-year fixed at now?
I haven't even looked
Guesstimate.
at that reason. I would say, and I don't know, I would say probably around 3.5,
Really?
something like that, maybe 3.25, maybe. It's not a full percentage point spread.
Yeah. So I mean, it actually seems like, I mean, there's a significant spread over the Treasury there as opposed to on a 30-year. I mean, if the 30-year was right around 299, and then you're basically marking up another point, which is not bad. But I mean, it seems like on a short term, you're getting really screwed.
Yeah, you are. And hey, I want to take this time and kind of, I'll try to keep this to an hour.
Absolutely.
So hang on for me 1 second here, and I'm going to play the intro music here, and I'm going to do my little exit here. And thank you for being here, Max. And you certainly can give yourself a plug if you like. You like that music? So, hey, we're going to wrap this up here right now for this week's Real Estate Roundtable. We try to keep it to an hour. We can't always do that, but we try to do that because we want to be cognizant of your time, because time is valuable. So if you want to check out other episodes, please visit my YouTube channel or check out my podcast at www.Valley of the Sun Real Estate Show. From there, connect with me on any social media, and I will connect with you back and reach out to me. And if you're certainly going to purchase or refinance a home in Arizona, I would love the opportunity to earn your business. So please reach out to me. We lost Jorge due to some technical difficulties, and that happens during a live broadcast. We can't do anything about that, but hopefully he's still in the chat room. So check out Jorge Cuervas on Twitter. He's at Jorge Cuervas, and you can check him out on Twitter. So with that, we're going to go ahead and end this episode, and then we'll continue with the non-recording episode. Thanks again for attending. Thanks, guys.